This is InvestTalk. Independent thinking, shared success.
Hi, this is Susan from New Jersey. I'm calling about stock, Axon, A-X-O-N, Axon Enterprise. What would be a good entry point? It looks expensive. Thank you. Bye-bye.
So Axon Enterprise, it's ticker AXON, is a provider of law enforcement technology solutions, including tasers, body cameras, but also the cloud-based software to keep it all in one place. Now, in terms of growth, it's been stellar over the past 6 years, 30% on an annualized basis over the past 5 years, from $530 million in revenue in 2019. They grew to $1.1 billion by 2022, projected to be $2.5 billion by the end of this year. And in that time, net income has grown 42.9%. 42.9%. Net margins have also remained pretty stable. A previous high of 12.4% net margin in 2022, projected to be 12.5% this year. And in this time, cash flow has improved. The profitability, like I said, has improved. They have very little debt on their balance sheet. They're a $46 billion market cap company. They only have about $721 million in debt. So they're not really levered at all. And so they haven't financed themselves through debt. And as you can imagine, given that they only started making money in 2022, well, they also issued a lot of shares, right? From about 60 million in 2020 to about 72 million by 2022, about 75 million now. And in a similar fashion with companies that just recently started making money, they don't pay a dividend yet. And so with that growth, at a time when more and more body cameras were being ordered by police departments across the country, with that growth, is it still a good time to invest in it? Well, the caller hinted at it being expensive, so let's take a look at that right now. Forward-looking price to earnings, 95 times. Price to cash flow, 158 times. Price to sales, 24.4 times. And so it's possible that, well, it is justified by the strong Q3 earnings that we saw, a new bundle within their software that is more AI-driven, that has hopped on that secular growth theme. I mean, there is a reason why it's up 134% over the past year. But frankly, where it stands right now isn't just expensive. It's expensive by its own standards. Its average forward-looking price to earnings is 72. It's at 95 right now. Its average price to cash flow, an outrageous 109, still below the 158 it is. It is double the price to sales that it has been typically over the past 5 years. And so although growth looks great, and it is slowing, it looks great, but it is slowing, right down from 30% to just over 25%, or just under 25% now. I think overall, this name is just a little bit too expensive. Maybe even a lot bit expensive. And so this stretch valuation, especially in a market that is pretty expensive in and of itself, lends to some asymmetric downside risks. And because of that, I think on AXON, I'm gonna have to pass for now. Thanks for the call. Now, we already hit on a voicemail today, and let's go to the InvestTalk YouTube question bank. And this question came in from the Data Daddy, and that is Daddy with an I. I want to be very specific about that. That is Data Daddy with an I. And the question is about ticker DG, and it says, hey there, longtime listener, love the show, and now the YouTube channel. Glad you like that. Wanted to get your analysis on DG for the short, medium, and a long term. Starting to look attractive to me at these levels, but would like to hear your thoughts on an entry point. So taking a look at DG, that is Dollar General. I think recently we've gotten a lot of questions about that, and that's because it had a pretty decent drawdown over the past year, down 47% over the past 52 weeks, down 6.7% year to date, down 12.82% in the past 3 months. Now, why is that? Because you look at growth and it's still growing. Right? Revenue from $38.6 billion projected to be about $40 billion in this fiscal year, which is fiscal year ending in January 2025. So we should be getting that pretty soon. Now, even though you do see growth has slowed, but mostly it's two things going on here. One is consumer behavior. spending in the customer base of the Dollar Generals of the world went down. Lower income households were disproportionately affected by inflation. And because of that, their spending power is diminished, moved back towards essentials, away from some of the other things that has driven the growth of Dollar General's revenue over the past 5 years. There's also the more important part, which is it's a more competitive landscape now. It used to be the case that for these types of goods, you'd have to go into a Dollar General, you'd have to go into any various stores, you'd have to go into Walmart. But what's happened, right? The proliferation of Amazon Prime, the proliferation of Walmart, all of these companies that are moving not just from the brick and mortar, but into online retail as well. And so that is diminishing the reach that Dollar General has. That has also hurt their top line and also hurt their bottom line. And there's also something else on the horizon. Something else on the horizon that I've been talking about already, and we're going to have our main focus point about it, and that is tariffs. The reason why a lot of these goods are cheap is because a lot of these goods are imported. Our biggest trading partners, two of our biggest trading partners, Mexico, Canada, potential 25% tariffs, threats against tariffs on China as well. And so that could hurt the profitability of these companies. So it makes sense to me that Dollar General is underperforming the market, its industry. It's broken past any layer of support it had, and it's continuing to head downwards. So although it looks cheap, the thing about cheap stocks is sometimes they can become even cheaper. I think there's just too much risk out there for what could affect Dollar General's top and bottom lines. I think there's way more competition than there used to be. And so because of that, on Dollar General, gonna have to pass. Thanks for watching, and I'm glad you love our YouTube channel. Let's go to Tom from Kentucky. There's a question about TSCO. Do you own it, or are you looking to buy it?
I own a few shares, but I was looking to see what you thought was a good price for it. I know it's just been on a long rise, it seems like, and it split a few months ago. So I just want to get your opinion on it.
Awesome. Well, thank you for calling in. You're the first live caller of the day, so we really appreciate that. And so let's take a look at Tractor Supply Company. Tractor Supply Company is a, let's say, rural lifestyle retailer in the U.S. It has a wide range of products from livestock and pet supplies, hardware, tools, seasonal items, pretty much everything you could possibly need. And its revenue is split, I would say, pretty evenly between its major business segments. Its livestock division, about 27%, seasonal recreational division, 22%, companion animal division, 25%. So it's got a pretty good diversity of product lines. And it's also got great revenue growth, about 13% on an annualized basis over the past 5 years. Now that has slowed down a bit, right? It only grew from 14.2 billion in revenue to 14.5 from 2022 to 2023. And really started to slow down again headed into this year, but it's starting to pick up from 24 to 25. And so that's something that we do like to see. But not only is revenue growing, net income is growing, and margins are staying pretty steady, right? 7.5% net margin is pretty good for a retailer. And so while the rest of the industry is down, it's outperforming the industry by about 5% this year. In the past year, it's up about 23%. Year to date, it's up 8%. Now, over the past 3 months, it's down 1.4%. But as you mentioned, there's a pretty good rise in that. And so it was consolidating a little bit. After trading about $46, it got to a high of about 60 and then started to consolidate in the 54 to 56 range. And so looking at this name, again, it's got pretty good growth. It's got great margins. Its cash flow, let's look at its cash flow. Its cash flow is pretty steady, but it also buys back shares. It has a dividend yield of about 1.55%, which is pretty much where it's been over the past 5 years. So not a big payer, but a payer nonetheless. And it also has short interest of about 6% out there. And so is that a signal that maybe valuations are a little stretched with growth slowing down? Potentially. It's trading at the upper end of its 5-year range, 25.7 times forward-looking earnings, 23 times price to cash flow, 2 times sales, the upper end of its range. And so I tend to agree with the market here that I think this is a company that had great growth over the past 6 years, front-loaded into really the past 4 of that. Growth is slowing down. And so to me, it looks like valuations are a little stretched. It doesn't look like a sell to me. It's not in the sell range, I would say. But either way, I think it's going to probably be a little choppy trading as it consolidates where it's consolidating now between that 53 to 56 range. I wouldn't buy any more. It could really move either way from there because the valuations, like I said, do look a little bit stretched. Thanks for the call.
Hey, thanks for taking my call, and I do own it. I'm just wondering if I should hold on to it, sell, or trim.
Okay, well, let's take a look. ARLP, for all those listening, is Alliance Resource Partners LP. It's a diversified natural resource company, and what they primarily work with is coal. And so you'd expect, right, with the drill, baby, drill, unleash American energy approach, that maybe now is a good time to start to invest in coal. Now, this company's up 25% over the past 52 weeks, up 11% over the past 3 months, up about 5.6% this year. But when I'm looking at revenue growth here, it doesn't look too sharp. Now, again, if you have a change in administration, a change in energy policy that emphasizes coal more, well, then you'd expect that maybe there's a lagged effect in terms of when revenues grow as it is start to being used more as an energy source. Now, one reason why someone might see this name and say, I need some of this, is it has a 9.85% dividend yield. Not nearly as high as the 21% dividend yield it had in 2020, but still very, very high. And its payout ratio is only 58, so it has a lot of room to run there. Now, they haven't issued many shares. They don't have much debt, only $492 million on the $3.6 billion company. And their cash flow, although starting to drop off a little bit, has still improved steadily since 2020. We like that. Their margins, it looks like they started to expand a little bit headed into 2023, where they hit a peak of 23.8% net margin, and then coming back down to earth at about 17%. Still a pretty solid margin there. And with all this in mind, they're pretty much on the lower end of their 5-year range. Forward-looking earnings, price to forward-looking earnings is only about 8.9 times. Price to cash flow is only 5 times. Price to sales is only 1.5 times. And so I think my question here is, it's had a run up, certainly has had a run up, right? From March, it was trading at about $18 per share. Now it's trading about $28 per share. And so I don't know how long you've held on to it, but I imagine that if you bought it any time in the past year, you probably have a little bit of profit here. And so I think that coal is one of those names that probably has a little bit of irrational exuberance here. We've been talking about this over and over on the show with the drill, baby, drill approach. And this kind of falls into that category here. De-emphasized energy sources over the past 4 years naturally have seen price appreciation in the wake of Donald Trump's election. But we still think here, and I still think, that the names that are going to do the best are the names that have to do with increasing the efficiency of getting goods to market, and natural gas names, still not that some of the dirtiest energy, right? And so what I see here is an opportunity to start to trim and take profits. I don't think you need to sell here because, frankly, again, from a relative valuation perspective, it is pretty attractive, but likely you have some pretty solid profits here. I think maybe diversify across the energy space, hit some of those natural gas names, hit some of those midstream pipeline names. Sound good?
Yeah, sounds great. Thank you.
Awesome. Thank you. Now, we already talked about tariffs, and we have talked already about energy. And so let's talk about a surprising opponent of the latest move by President Donald Trump to remove us from the Paris Climate Agreement yet again. And that is the U.S. oil and gas industry, right? They're celebrating this renewed push for domestic energy production, but not agreeing with all those decisions. His move to withdraw from that agreement is causing concern among major energy companies who fear not just regulatory uncertainty, but an increase in global market risks. Big oil has long been viewed as a driving force behind climate change, but major companies like ExxonMobil and Chevron had urged Trump to remain in the pact. So why? Right? They argue that participating in the global climate talks provides not just stability for long-term investments in green hydrogen, carbon capture, and other emerging technologies that a lot of these traditional oil companies, oil and gas companies, have started to devote resources to investing in, but also alongside the American Petroleum Institute, which represents the industry and has also expressed support for the Paris climate goals. They warn that exiting the agreement after the U.S. rejoined under President Biden creates not just a policy whiplash that makes it harder to plan for the future, but it also makes it harder to have a say in what rules are agreed to. Additionally, it raises legal and regulatory risk. Companies have to navigate inconsistent climate policies across different countries. And so despite Washington's retreat, the private sector, right, despite what the public sector is doing, despite what the government is doing, it appears at first glance that the private sector is still committed to its green energy investments. In fact, U.S. carbon emissions have already fallen 17% since 2007, largely due to the shift away from coal. But with Trump signaling more deregulation, the energy industry faces, I would say, a more complex situation than it has in a while, balancing those short-term fossil fuel expansion with those long-term climate commitments, a lot of which the investment seems to be irreversible. Let's keep things moving and get to another question from our InvestTalk YouTube comment section question bank. This one about a hot button name, I would say, more recently. And it comes from Michael Seneca 5534. And this question is about ticker RGTI. That would be Rigetti Computing. It says, what are your thoughts on Rigetti Computing? Well, that is a short, sweet, and simple question. So let's try and give you a short, sweet, and simple answer. So Rigetti Computing is a quantum computing company. And if you're looking at my screen, you see a lot of relative underperformance to the S&P 500. And then the past year up 1,164%, most of which came in the past 3 months, up 1,030%. And the reason why it is up so much in such a short period of time was on the back of some news about some breakthroughs in quantum computing from Google. And it seems to me like this is another situation where you have potential steps forward, potential big steps forward, and possible overreaction from investors, from market participants, from just about everybody. And in fact, the CEO agrees with me, right? He emphasized the need to manage expectations, noting that while there's promise in quantum computing, the processes, the applications, everything's in development. And so similar to when you're investing in one of those biotech names, this is going to be a company that is not making any money. It's going to be a company that's issuing a ton of shares. It's going to have little debt, and it's going to have no money-making possibility in the future. Or rather, on the horizon, right? There's a possibility in the future, but certainly not on the horizon. And so with that in mind, given that we're potentially in a higher rate environment, is it worth shooting at this company hoping it is the one that is going to have major breakthroughs? I don't know. It's up over 1,000% in the past 3 months. And so even if I was considering buying into this company, though the CEO is telling us, calm your expectations, certainly after the most recent run-up, when there's all this exuberance in the marketplace, I don't think now is the time. Thanks for watching. Now let's pivot back to the InvestTalk voice bank and answer this question now.
Hi, Justin and Luke. This is Sid from Charlotte, North Carolina. I'm looking for a ticker symbol PLBY, Playboy. I have some position, but obviously it is at more than 50% down. So if you could advise what is the right strategy. Lately, it has gone up, but not sure, should I take some loss or stay in the game? I'll hear your opinion on the next podcast. Thank you so much. Have a great day. Bye-bye.
So Playboy's had a rough past couple years. Right. At one point, it was trading at about $28 a share. Then it dipped as low as about 50 cents. And now it's back up to about $1.85. And so it's had some interesting deals recently. A $300 million partnership with Byborg Enterprises, a webcam entertainment company. And maybe that is why over the past 3 months it's up 117%. But other than that, it's been lackluster. Sales are down dramatically. They do not make money. This is a company that is, its best days are frankly behind it. And so if it were me, I think this is a perfect example. This is a good time for a general lesson. People have a bias where they tend to hold on to their losers too long and sell their winners too early. And you can think to yourself, okay, I'm down 50%, even though there's been a recent pop. Should I wait and see if I can make some of this money back? And so you have to think of it in the way of not just, how is this stock going to do, but how is this company going to do relative to the rest of the market? There's an opportunity cost to waiting to take less losses than you already have. And so in the situation of Playboy, who is a $160 million company with $211 million in debt, who does not make money, whose cash flow is, yes, improving, but still negative, whose profitability is negative, who's issued a bunch of shares, and who, even though it's trading at $1.85, has a bunch of short interest, there's still weakness within the company beyond this partnership that may have led to this pop. And so with that in mind, look elsewhere. Take the losses, add it to your tax returns for next year. There are better opportunities out there. Thanks for the call. Let's play two in a row. This one from 888-99 chart.
Hello, guys. I'm calling about Deutsche Bank, symbol DB. This stock is going up quite a bit now, 52-week high. I own it. I'm a little bit surprised because this is a German company. Germany is not doing well. Dollar is strong. Yet this company is going higher and higher. Can you please tell me, is this a good time to trim it or wait a little bit longer, maybe trim it later? Another question, if you guys have time, is about cannabis industry. Lately, it's been very, very low, going down. Should we think about start buying ETFs, cannabis ETFs? When everybody's thinking about something else, cannabis is maybe a good time or a good investment to start to get into. Thank you.
Let's tackle the first part of this question first, and that is on Deutsche Bank. Now, Deutsche Bank is a German bank. It's up 50% over the past year. It's up 14% year to date. Pretty strong performance year to date. And the reason why it is up so much is because, well, it's had some pretty strong profits. It has a strong balance sheet. And there's been a focus on shifting towards more sustainable growth avenues within the business. Now, this is similar to U.S. financial companies. U.S. banks are doing very, very well. They started off the earnings period, the beginning of the year, showing fantastic earnings, especially within investment banking divisions, not just asset management divisions, not just commercial banking divisions. But all banks are doing, I wouldn't say all banks, but most banks are doing pretty well right now. And so even though you have Deutsche Bank, which is a German bank, and the German economy is slower and sluggish, it's still an international bank that does international financing. Now, with that being said, Deutsche Bank also carries an interesting risk profile. They've been involved in a lot of scandals in the past 10 years, some illicit activity with some questionable individuals. And so is that a risk you want to take on? And is there really an added benefit if you're talking about these banks that are global banks, right? Not just inherent to the countries in which they operate. Is now a good time to be in Deutsche Bank? I would say, frankly, I prefer US banks, large US banks. They have wider range, the dollar is pretty strong, and they don't really have the illicit checkered past that maybe Deutsche Bank does. And so if you're up, that's great. I would probably start to trim, take profit. I think there are just some risks given the history of Deutsche Bank and honestly given where the German economy is. Now, the second part, cannabis ETFs. Sometimes when things are down for a reason. And certainly with a change in administration, a change in opinion on the cannabis industry broadly, it may be the case that, well, you have changes in enforcement policies, changes in federal policies that can certainly affect a lot of these companies, a lot of which don't operate on strong margins, a lot of which can't really stomach the regulatory scrutiny that comes with a change in administration policy towards what is likely to come over the next 4 years. And so with this drawdown, does it make it a good time to buy it? No, I think this drawdown makes a lot of sense. Again, a lot of risks out there. You have to think of things in 3 levels here. How is the market digesting it? What is going on with the individual company on a micro level? What's going on with the macro economy on a global level? And so the macro factors, the headwinds, I think, are probably against cannabis ETFs. And so even though they look cheap, again, could always get cheaper. Thanks for the call. Now, when we come back from the break, we're going to talk about an interesting topic. And that's because I feel as though over the past several years, private equity has become a hot button issue. Private investments have become a hot button issue. And that's because you see these returns, but you don't really see these returns. You'll understand what I'm talking about when we come back from the break.
Justin, Luke, this is Brett from California. I'm looking at a good, solid cybersecurity company, and the ones I'm looking through, I feel like CrowdStrike is probably the best one. I just made a purchase today, just going to start dollar cost averaging that all the way up, or when it starts to come down. Just want to talk to you guys and see if that's a good move, or if you feel like there's another one out there that I should be involved in. Yeah, I'd love to hear about your answer on that. Thank you.
Well, some of you may know CrowdStrike well. That's ticker CRWD, and it could be because your business uses it. They are a cybersecurity service company. They try to stop breaches. Or it could be because 6 months ago they had a wild IT outage that grounded every airline but Southwest and crippled most of the world for a little bit because of a issue in a coding update. In spite of that, they're up 22% over the past 3 months, up 26% in the past 52 weeks. That's because their salespeople are real good. I'll tell you that, first and foremost. The revenue growth is fantastic. Up from $481 million to $3.92 billion in 5 years. Their net income growth, phenomenal. Their margins, about 24% is where it's projected to be this year. And certainly in 2025, as was in 2024, cybersecurity is going to continue to be an important topic. Their cash flow is improving. They have very little debt, though they issue a decent amount of shares, up from 210 million to 250 million the past 5 years. And so the question is, with all of this in mind, has the market forgotten about what happened? Now it's expensive. It's trading at 84 times forward-looking earnings, trading at 65 times cash flow, 24 times sales. And a lot of these companies do trade at these levels. But if I'm being honest, with the name CrowdStrike, with what happened, with how contracts work within the tech space, it could still take time for the consequences of what happened to bear out. Maybe people don't renew contracts at the end of the year. The beginning of the year, rather, which is now. And so even though it's up 3.16% today, it's pretty expensive. And non-renewal of contracts may not cause a precipitous drop, but it could hinder growth going forward. And so for me personally, I'm not comfortable with CrowdStrike until I see probably another couple quarters, see if we have a real effect 1 year after that big issue that grounded the world for a while. That's CrowdStrike, ticker CRWD. Thanks for the call. Now, as I mentioned before the break, a coalition of U.S. pension funds and institutional investors is pushing for greater transparency in private equity, aiming to standardize reporting on fees and investment returns. The Institutional Limited Partners Association, which includes major pension funds from California and Texas, has proposed new disclosure guidelines to level the playing field for investors. Public pensions and endowments have doubled their private equity investments since 2018, making them some of the industry's biggest clients. Yet many small and mid-sized pensions lack access to the critical financial details, leaving them unable to fairly compare fund performance. Now, while large funds can negotiate better reporting, smaller investors often pay higher fees and receive less information. And the stakes are high. Private equity AUM, assets under management, have tripled over the past decade. What have fees done? Grown 6 times. Some investors claim firms are using financial engineering What does that mean? Well, they may borrow against assets in order to inflate short-term returns and justify higher fees. Private investments tend to have smooth investment experiences because they're less liquid, they're not priced, they're not mark to market because there is not trading all the time. And on top of that, efforts to enforce standardized reporting, they've stalled. The SEC attempted to mandate uniform disclosure, but private equity firms successfully fought that rule in court. Now, pension leaders hope this latest push will bring voluntary reforms, but with demand for top private equity funds still outpacing supply, honestly, fund managers have little incentive to change and little incentive to provide the transparency that I think investors deserve. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads, which you can get at iTunes, Google Play, and Spotify. Remember, we can help you better understand your portfolio dynamics, help you calculate your investor risk number, maybe even help optimize the potential of your 401k and develop a full financial plan for you. It all starts over at investtalk.com. Just head over there and click the portfolio review button. This is a free and confidential service. Independent thinking, shared success. This is InvestTalk. Good night.